Hey, what's going on, y'all? It's Rashard back again with another video, right? So I wanted to make this video about because I seen this post yesterday on Facebook, right? And it said that if you want to make your child a millionaire, invest $1,000 a month into the S&P 500, right? So I wanted to make a video about that, right? Because it got a whole lot of shares, and that's fine. That's cool, the S&P, but what people fail to realize is that is an investment, right? Investment equals risk, right? So, yeah, you can put in you got a young child, you want them to be a millionaire by the time they grow up and have funds to access. Yeah, you can put $1,000 in there a month, but who's to say what the market's going to do? You know what I'm saying? So, yeah, you absolutely can do it, but what's going to happen if the market crash and you putting $1,000 in there a month? All that money gone. So investment equals risk, right? And you take on all that risk, right? But with a whole life policy, there is no risk. I know a lot of people might think that sounds crazy or something like that, but there is no risk, right? It's all guarantees. And that sounds better to me than risking my money into a market that could potentially crash, you know? So what I did was I put together a whole life illustration, right? Monthly premium, $1,000, right? Baby girl is her name, age 2. So this policy from the age from she 2, right? So, and this is this is just an example. This is just me going through some things with you guys. I had did a 45-55 split on this one. So 45% of the $1,000 a month going to go to the cost of insurance, which is the death benefit, and 55% of that will go to the cash value, right? Okay, so we looking on this side, right? So first year, right? 12,000. You only got 7,600 in there with a 40 40 $443,000 death benefit, right? With a $1,300 dividend, right? But then let's get to the meat of it, right? Okay, so we are looking at year 9, right? Let's look at year 9. Year 9, she would be 11, right? Okay. So you have put in $108,000. $108,000. This is what you have put in. Now, your dividend will almost $5,500. Hey, you can't beat that, right? But look at the cash value. Look at the bank account for her, right? For your baby girl, right? And this is the death benefit because we tend out to leave out the coverage that's here. We talk about the cash value and all the other good stuff, but we leave out the death benefit, right? Because that plays a big part in here too, right? So look at the death benefit, $768,000. But notice how in year 9 we on a positive side now. $1,700. Not bad, right? So let's go down. Let's keep going. Let's keep going. Let's go to year 15, right? Year 15, baby girl, she's 17 years old. And she's getting big, she's learning new things, and say you didn't put in $180,000 into this, right? 180, that's a lot. That's a lot. But look at that dividend. $9,000. Oh, come on now. Can't beat that, baby. Stay with me, baby. You can't beat that. Not at all, baby. Not with a hammer you could. Yeah. So let's look at the cash value. Let's look at the savings account for baby girl, right? Look at that. We up. We all the way on the green with a $1 million death benefit. Come on now. Stay with me, baby. Now, this is just something I put together, right? This is not something permanent. So now this right here means that it max out at year 22. And when you max out, that means that you would lose some tax advantages, right? But it's all type it we got strategies to get around that 1035s, whatever, whatever. So this is just an example. So that's all I'm using it for today, right? So let's look at year 20, right? Year 20, baby girl, 22 years old. She 22, she's a young woman. Maybe she's getting into business, she getting into real estate, she want to do her own thing. I think in 20 years, like credit scores, like if you set this policy up, by the time she's 22, you think if she has $353,000 in the cat in her savings in her bank account, right? Do you think she's gonna be worried about a credit score or having to go to a bank to get a loan or anything like that, right? No, she won't. She's able to do everything that she wants to do. She want to buy a business. She want to buy some property. Anything that she wants to do, right? She can get it done with that. Okay. So let's just look. She got you have put $240,000 into this policy. This out of your pocket, right? Out of your pocket. Bam. You get a $12,000 death benefit. I mean dividend. I'm sorry about that. Dividend, right? Look at the cash value. That's the bank account, right? No risk. This is all guaranteed with a $1.3 million death benefit. Hey, I don't know about y'all, but my kids got to be set up like this, right? My kids got to be set up to where they not going to need anything and no extra funding outside of this. Whatever business endeavor they want to go into, guess what? They can. She can. Baby girl can because guess what? We set it up for her. That same $1,000 a month that you would have put in the S&P 500. But oh no, get her whole life policy. Cause why? It's protected. It's guaranteed. It's no losses on your money, right? That's what we want. That's exactly what we want, right? So we just scrolling, right? Let's say baby girl hit 40 years old. She is grown, grown, kids, married, properties, whatever. And she been having this policy since she was 2 years old. She running the money through it, paying herself back, everything, right? Now at the age of 40, right? I put in $456,000. Man, that's a lot of money. Woo, out my pocket. Woo, that's a lot, baby. Hey, that's a lot. But look, you get a $37,000 dividend. Oh no, you're gonna get that. You're gonna get that, right? Okay. Let's look at the cash value. 1.1 million. Look at the death benefit. 2.7 million. 2 point. Come on, y'all. Look at these numbers. Let's look at the numbers. This is guaranteed. No risk. I think this is better than S&P 500. To be honest, I think this is better. Now, if you like taking the risk, I mean, the S&P, hey, that's fine. Take the risk, right? But if you want guarantees, you want your baby girl to be able to grow up and not have to worry about filling out loans, worried about credit and all those other things that might hinder you from getting property or whatever you want to do. I would say a whole life policy for sure. Off the back, we saying whole life policy, right? Just look at it, just makes more sense to me, right? It just makes more sense. It gotta make sense, right? So if you get a death benefit, right, with the savings component and an annual dividend for the rest of her life, right? For the rest of her life. And look at that. We got three threes. Come on now. Come on now. Y'all hear me talking, baby. Stay with me, baby. Okay? So, man, it just makes more sense. It just makes more sense to have a whole life policy with no risk better than a S&P account for the kids, you know? So I would definitely say look into a whole life policy. You know, it's just all about what you want to do, how you want your kids to be set up, what type of financial system are you trying to set up for you and your kids. That's it. It's just all about you. How are you trying to move? How you want your kids to be able to move in the future? Now, I can design this any type of way. $500 a month, $200 a month, $100 a month. We can design it any kind of way. So if you got questions about the best options for your kids, how early they can start, want to look over a couple policies, email me, DM me, let me know. We can set up some consultations and we can get it done. Let's get these kids with some accounts that they don't have to worry about, they can really have access to when they get older. So this is what we really setting up. This is the generational wealth right here. So you want to learn more, you know, stay tuned. Watch out for the next video. Like, share, and subscribe. InfiniteLife.com is the website. Yeah, just come talk to me. Any questions, anything, just let me know. I'm happy. I'm here and I'm happy to serve you guys. All right. Thank you. Have a good one.